U.S. inflation came in lower than expected, but producer price inflation came in hot, suggesting future price increases for U.S. consumers. And that's not the only twist in the economic news this week. We've also got sports streaming by the day, big moves in local TV consolidation, and Chinese retailers defying the slowdown for now. Welcome to episode 73 of the WPP Media Intelligence Podcast. I'm Kate Scott-Dawkins, joined by Jeff Foster and Nidhi Shah. And each week we break down the numbers, trends, and deals shaping the global media and commerce landscape. And most importantly, what they mean for advertisers. Welcome, Jeff and Nidhi.
Hi.
Hello.
How's everyone doing this week? I got caught in some weather myself this week traveling to Chicago to meet with a client, so I'm happy to be back in California where it is sunny skies.
Yeah, it seems a never-ending heat wave here in New York City. We had a pretty bad thunderstorm the other day, and it's still very hot outside.
Pretty much the same here. We've got the fourth heat wave. Apparently feels like more like the 60th, so yeah.
British are never happy with the weather. It's too rainy, it's too cold, it's finally hot. You're still not happy.
That is true. It's never perfect for us, unfortunately.
Nope. All right. Well, let's start with some U.S. economic news, as we touched on in the intro. Then we'll get into media news. We have some results from Chinese players on both the ad seller side and gaming side. We'll touch on those. And then a little bit of a deep dive into AppLovin's as well, which I'm excited about. It's someone that we probably haven't spent quite enough time talking about so far this year, so we'll get into that too. But let's start with the U.S. inflation numbers, both CPI from the Bureau of Labor Services, at least for now, and then the producer price index as well.
Yeah, so we just had our U.S. inflation report, so it came in at up 2.7% year over year, but that was below expectations of about 2.8%. But then when looking at the core inflation, which of course excludes food and energy prices, it was up 3.1%, which was slightly higher than the 3% forecast. Kind of a mixed bag, I guess. Would that probably be the best way to describe it?
Yeah, and I think people were looking for, tariffs to have been flowing through already a little bit into those consumer price increases. We haven't seen that, but then I think it was that much more alarming, but like substantial when the producer price index came in so much above expectations. So we are starting to see tariffs in the data, just more so on the wholesale side and not yet the consumer price side.
Right, which would make sense, seeing it would flow through wholesalers first and then obviously hit consumers later. I think there's been a little surprise that maybe it hasn't quite come on its full force yet, so maybe something to keep an eye on for the second half. But on the producer price index report, which just came out too, it was up, plus 0.9% from June, lifting the annual rate to 3.3%. Expectations were for 0.2% year over year. So yeah, definitely coming in very hot. And then looking at core PPI again, which excludes volatile food and energy prices, that rose 0.9%, which was above expectations of 0.3%. I thought a couple interesting things in there was the cost of partially finished goods rose 0.8%, and prices for raw materials leaped 1.8%. So I guess could that be some signs of tariffs that we're seeing?
I think tariffs, and there are still a few commodities. Coffee and cocoa continue to be well above historical averages. Those may be playing a little bit of a part as well. You have the additional tariffs on things like aluminum and metals. So I think we're seeing now all of that in the data. The question is, how much are companies going to try to shield consumers, and how much are they going to pass through?
Yeah, I mean, as of now, it seems like companies are taking on most of the brunt of the tariffs, but we'll see how long that holds up for.
Yeah, exactly. All right, so we're looking at, for advertisers in this space, looking at this data, I think the theme continues to be that it may be a slower back half of the year. Consumers may be a bit more concerned about purchases and what those prices are going to look like. But that we expect there to be, more information as we go through about how much retailers and manufacturers are raising prices to deal with this.
Yeah, absolutely. And I think we just hot off the press too. We also had our U.S. retail sales numbers, which just came in this morning. And those were pretty much in line with expectations. They were, let's see, up 0.5% in July, which was, and then June's was revised down 0.9%. So again, more, I guess the theme of the day is mixed messages, mixed signals, but definitely I think we can say that we're beginning to see some, simmering effects of the tariffs coming into play.
Yeah. As a reminder, when we hit that high inflationary period post-COVID, what we tended to see from advertisers, especially in some sectors like CPG, was investing alongside that, investing in messaging to support continued purchases of their products. They didn't want people to trade down to store brands. They wanted to continue getting people, purchasing their items, and they were willing to put media and messaging behind that. And so I kind of expect we'll see at least some measure of that. I think for the most part, at least amongst the large advertisers and the ones that we're hearing talking about mitigating these price increases, is that they understand how important continued messaging is in these scenarios. I think there's been enough research and data about what happens when you go dark that's ideally not going to be on the plate for them. I think what is a little bit more unclear is in those small, medium-sized businesses that make up the vast majority of sales for Google, Meta, Amazon, whether they're able to continue funding advertising in the same way. We certainly haven't seen a slowdown in that spending from Meta and Google yet, where they're still, 20+% or 12% for search from Google this year. So again, haven't seen that trickle through yet.
Yeah, exactly. And I think you're right. I think especially from the larger brands, continue to see more messaging on strengthening brands and value, that type of messaging, which the data has proven has been pretty successful in the past. So I would imagine to see more of that playbook coming up in the second half of the year.
Yeah. What about overall growth in the economy? Because we had some good GDP data this week too, Nidhi, from the UK and EU and China as well.
Yeah, some really interesting shifts actually, particularly in the UK and Europe. There's been a lot of talk about subdued growth, right, at the moment. And the second quarter data the growth has been slower than the first quarter. And a lot of that is due to some of that activity shifting into the first quarter and due to the tariffs and, like uncertainty, especially with businesses planning and, trying to mitigate costs and upending a lot of that spend early in the year. So now what we're seeing is a lot of talk about second quarter growth being slower than the first quarter. The UK reported real GDP growth of about 0.3%, which was slightly higher than the euro area, which was about 0.1%. But I think that's a lot to do with the normalization as opposed to a complete slowdown, because when you see those figures on a year-to-year basis, both kind of and EU have posted a growth of above 1%. So still slow growth, but not necessarily completely bad. And that's kind of what we also project in our advertising forecasts as part of TYNY.
Yeah, I mean, for big, established, developed economies, you'd expect somewhere in that 0 to 5 for nominal growth, right? So a +1 real growth number feels it's not a negative, so that's good.
It feels about right.
Yeah.
I think what's really interesting is, particularly in the euro area, some of the real GDP growth in the Central Eastern European markets. So Bulgaria, Slovenia, Poland, really mid-high single-digit growth alongside Spain, which is interesting. And in the UK, services continuing growth alongside construction, which was a bit surprising, and production kind of falling in the quarter.
Yeah, everyone's always, at least in the US and the UK and every other market I can think of, there are never enough houses. So I think it's good to have the construction numbers going up. Hard to know whether that's more infrastructure or residential, but okay. Interesting. We also had China GDP growth, which, did continue into growth, but I think, not as high as I think they would have liked to be talking about, and certainly still being dragged by the ongoing housing values there, government actions that are, I think, widely not by our, I'm not a trained economist, but from reading articles, are looked at as not being quite enough to really jumpstart serious consumer expenditure. And you were talking about the non-essentials versus essentials, weren't you, Nidhi, before we got on the call?
Yeah, exactly. And I think in terms of the retail sales, what's interesting to see from the data that was released today is the kind of huge growth and outsized growth in non-essential items such as household appliances, audiovisual equipment, sports entertainment products, and kind of furniture and communication equipment. Relative to some of the essential items. And that's, partly to do with, the kind of government trade and incentives, right, that are stimulating spend. The question is, how long, do we expect that to last, and what impact, if any, does that have on like these various sectors? I know JD.com reported this week, and they saw huge growth in their retail division, about 20.6% in the second quarter, with a lot of that growth coming from home appliances, about 23.4%, which is faster than the kind of other general merchandise revenue they generate.
Yeah, so I don't remember if we've talked about on the podcast before, but basically the government, from my understanding, they're offering subsidies to people who trade in old appliances like refrigerators and TVs and everything else in an effort to get people to spend and prop up some of that retail spending and growth domestically. The question, like you said, is how long can that continue once everyone who needs a new fridge or TV has taken advantage of those subsidies? That starts to run out. I'm actually surprised it has lasted as long as it has. I mean, they started this effort back in the fall of 24. So we're coming up on a year now that these programs have been in place for various large household items. And so we'll see what happens as we get into coming months, whether there's still enough juice in that to continue boosting those consumer sales figures.
There's definitely a divergence, right? You're hearing in luxury, for example, where that kind of Chinese consumer demand has been subdued for a very long time. There are kind of exceptions to that growth, like Hermes and Tapestry reporting strong growth. But, if you look at kind of the mixed bag, it doesn't get more mixed than this.
Well, continuing to watch for China growth and what happens there across various sectors. We can pivot into a couple of the other the media owner side of things, with Tencent still being a Chinese company. They reported total revenue up 15%. Marketing services, which was previously called advertising in their reporting, was up 19.7%. It's in line with 20% growth in the first quarter as well. So this is, a very strong first half for Tencent. As a reminder, growth a couple of years ago was a little bit stunted, just, I think partly post-COVID recovery, partly government scrutiny of things like gaming and time spent on gaming, advertising from for-profit tutoring institutions. It feels like they've really sort of gone through all of that now and are, continuing on a high growth track with their advertising, especially, and also gaming. They talked a lot in the earnings note about how they're applying AI to improve advertising services, the same kinds of things we're hearing from other large digital players like Meta and Google in terms of improving matching, improving performance. They said that was a big driver of the marketing services growth. They also talked about more advertising happening in closed loop environments. So I think taking a page from retail media and those places where you have direct ties between media exposure and conversion or purchase or whatever that is. They're doing more of that. They're doing some of that within their Weixin search. That marketing services revenue within search was up 60% year over year. They said due to more consumer and advertiser interest in mini-programs, search results, and enhanced ad relevance, as we leverage LLMs to deepen understanding of merchandise and user consumption intent. And then the other thing they mentioned, high growth elements within their marketing and advertising unit. Mini-Programs marketing services revenue increased 50% year over year. And for those who I actually went on Reddit just to see what people said about these mini-programs, these are, we don't really have an analog in the US, I don't think. They're basically, depending on where they come from, I guess often the Tencent ones are a bit longer, like 10 to 15 minutes. There are others on services like Kuaishou and Bilibili that are more 2 to 3 minutes an episode, but like high drama, character driven, ending on cliffhangers, just these little tiny bite-sized pieces of programming, mini dramas they're often called, that are very popular in China and obviously driving significant revenue growth for the companies that are putting them out there. Have you guys watched any of these?
I have not seen any, but now I'm interested.
Right?
Yeah.
I haven't either, but it's spiked the curious me.
Yes, yeah. So, but it's an interesting, as we often see things coming from China to the rest of the world in certain aspects, short form video, TikTok. Some things haven't translated as well. I think still things like live commerce, where you had expectations that it was so big and so developed in China that it would flourish elsewhere, I think hasn't necessarily come true. There were reports earlier this year about TikTok Shop in the US, at least, kind of struggling to see the growth that they were expecting. So they've been around in China for some time. I guess, do we have any guesses on whether that's something that translates better here or more like live commerce where it doesn't get traction, and here being sort of like everywhere outside of China?
Yeah, I don't know. It's a tough one because there's been attempts. Obviously, there was what was it, Quibi a few years ago.
Yeah.
The Jeffrey Katzenberg backed, but that had some rather unfortunate timing, which I think it was launching right around COVID and right around the shutdown.
Yeah.
So that may not be the best comparison. So we had that, and I don't know. It's just it's a tricky one. At least here in the U.S., I could see it happening. I just think that there's been a lot of changes since COVID that may be behavioral changes that may not make it as easy as a market that it was pre-COVID, if that makes sense, like commuting or lunch breaks in the office where you might consume these things a little bit quicker on the go. Maybe that environment's quite not as robust in the US as it was.
Yeah. So the opportunities to watch, obviously, you'd expect to need unlimited broadband or 5G, right?
Yeah.
To be able to watch these things on the go.
Right. So if you're sitting in your car commuting, it might be a little bit more difficult. But in cities that have more mass transportation, the New Yorks of the world,
likely,
might have a little bit better. But again, you're underground, so it's a little trickier.
Yeah, interesting. Okay, well, there you go. So we touched on the structural issues as to whether mini dramas and mini programs can catch on. But you could see, I think, sponsored ones would be interesting from a brand, right?
I think there's also the element of cultural differences as well, right? Like some people prefer to have longer content, and in the UK, I can speak for myself. When after work, I want to watch something for an hour and a half, just to kind of segregate my commute and my work life with my kind of personal life. But that's me.
Yeah. Be interesting to do some cool mashups. Like you had the whole Danish noir hour-long sort of crime-led drama. Like what would that look like in a 3-minute mini program?
Yeah.
What else? Where should we go next? We had loads of U.S. media news, Jeff.
I think one of the interesting ones was the Sling TV announcement that came out. So Sling TV is, of course, owned by EchoStar, and they have an announcement which, looks like they're targeting sports fans with $5 per day passes to stream any channel, and it's an orange plan. And their orange plan includes a Disney Channel, a bunch of ESPN programming, TBS, a lot of the Turner programming as well. So it looks like they're going after the sports fan. They also have a weekend pass for $10 and a weekly pass for $15. And just to keep that in mind, the monthly subscription or the monthly fee would be about a $40 fee. You're not saving much buying the weekly passes. Actually adds up to be more. But if you're just looking to, watch football for a weekend or a big sporting event. It does give you access to your local stations as well. So, for example, if you want to watch the upcoming Olympics and just want to get a couple weekly passes, this would, it's a pretty compelling price and product. So it's going to be interesting to see if this catches on. I mean, I can see the appeal, especially for cord cutters or if you want to go to your friend's house one week, they buy the weekend pass to watch football. Then you go to a family's house the next week. It can help save some money, across the board. Yeah, it's interesting. What do you think? You think this is are we going to see this from other providers and other services? Will we see a day pass from like a Disney Plus, a Paramount Plus, that type of thing?
It's a good question. I mean, with sports, they do maybe there are diehards who have to watch everything. And then there are those who, like you said, an event or you're having family or something, right? I think something like a Disney Plus probably depends on the audience. There are some people that have, young kids and they just want to be able to put it on for a half hour every day or something.
Yeah,
so
exactly. Just the bulk of the content. Yeah.
But it's interesting. I mean, both the mini program, we're talking about chunking things down into bite-sized pieces and smaller amounts of things. I don't know how much it'll catch on. Ties to the 2030 survey that we ran, that we've talked about a couple times in the podcast. I first ran the same survey. We've added some questions since then, but I first ran the same survey in 2020, right before COVID hit, and we were asking experts across the industry whether they thought micropayments would become a viable sort of alternative or complement to advertising and subscription payments for publishers. Our experts were pessimistic at the time. We asked them again earlier this year. I feel like they're still super pessimistic. This is just something that has not managed to get off the ground, despite it seeming like a really good idea. Yes, I want to read this article. I've had to, go to an article, hit a paywall. I want to read that article, but I don't want to, take the time to put in all my data and subscribe for a full month because I don't know how many I'm going to read. So it feels like it should be such a good idea, but we haven't been able to get the financial services and the, publishers to join together in a way to make that work. So will more companies do it? I don't know. I mean, there is still some payments that go to things like rentals. It feels like that, right? I don't want to either because it's a new movie and so I'm just paying for that, or I don't want to pay for the whole service. I just want to pay for a season of something. So I could see some of that more happening, but I wish it would happen on a much broader scale, right?
Yeah, no, I agree. I still think it's interesting because if you're a budget conscious sports fan, this is definitely an interesting way. You buy weekend passes, or if it's like the March Madness tournament, you buy it for a couple of weeks and you can still save a lot of money. It's just it's just a question of how big that market is.
Well, and how much does it help Sling stay in business? There is still a lot of consumer spending tied up in like multi-video programming distributors. That's MVPDs and virtual MVPDs, which Sling is what we would call a virtual MVPD. And so that is equivalent to, I think, I've just rerun the numbers. We'll put the chart out with the LinkedIn post, but that has been declining. It's still, I think, just over $90 billion in aggregate for 2024. The largest chunk of consumer spending on video still went to those basically pay cable services. Streaming is, the only thing growing, really.
Right.
So it's taking up a larger and larger share. Movies, pretty consistent. Cinema, I think, was like $8 billion in spending for the year. Maybe this is consumer spending now, not advertiser spending on cinema. But there's still room as people figure out what types of business models, revenue models make sense, right? I think more options for consumers is good as long as it doesn't add too much to the friction on the back end and costs on the back end of managing all these one-off purchases.
Yeah, exactly. And I guess we'll have some good ideas soon. We have a new ESPN and Fox service starting within days. So in the next quarter, we should get some more interesting updates on that.
Well, should we do the rest of US TV first, actually? And then we can sort of talk about TV and US traditional advertising before we move on to a couple of other players.
Yeah, sure. So I guess we have some consolidation news potentially on the horizon with the Tegna Nexstar announcement that Nexstar is in advanced talks to acquire its broadcast rival Tegna. That could be a fairly large transaction. It comes, been a lot of speculation about consolidation in the U.S. TV industry, of course, driven by cord cutting and streaming, as we just talked about, and the expectations of looser regulations under the Trump administration. So, just the quick context is that there was a recent U.S. appeals court that struck down the FCC's top 4 rule. So, basically, that rule was in place to limit excessive control of TV stations that were affiliated with ABC, NBC, CBS, and Fox. So currently, a company can't own TV stations that reach more than 39% of TV watching homes in the U.S., but it looks like that rule may be going away, which would open up a lot of consolidation, especially at the local level. So I think this is an interesting one to keep an eye on because Nexstar owns and partners with over 200 stations in 116 markets. They also have the CW News Nation, and they're increasingly focusing on sports. And Tegna has 64 stations. They run the True Crime Network, and Tegna's market cap is about $3.3 billion in that range, and Nexstar's is about $6.3 billion. So I think this, is an interesting one to keep an eye on. It kind of signal a lot of consolidation in the coming year.
Yeah, I'm sort of torn. We're currently with a couple of different companies looking at what happens when you do get a bunch of consolidation, whether that is the Apple App Store and Google Store and the Epic suit that just came through, or Google's search antitrust trial where we're going to get remedies for that soon and understand what the judge has determined in that space. So there are always watch outs for greater and greater consolidation. In this case, it's a little bit different now, I would say, than when the rules were put in place because people are getting their news and information from so many different sources. And so consolidating the messaging distribution to TV households is maybe slightly less problematic, given that we know from Pew studies and elsewhere that lots of people are getting news from, I don't know how I feel about this, but like TikTok and YouTube and all these other places, we have seen this decentralization of news. A lot of the commentary, and we've mentioned this before, is still coming off the back of, journalism from the New York Times, the Washington Post, or, NBC, wherever these places are. So I think at that level, you need to maintain independence and various points of view, right? To be able to Fox if you want, or NBC or whatever else. But I can see the appeal in the current sort of cord cutting environment to be able to scale up even more.
Yeah, and then it makes you think, especially from the advertising point of view, if you see some of these transactions going through, do you think we'll maybe see more of a self-service buying options, for small and medium-sized businesses, especially since you'll have a lot of local stations under one company potentially, so that could open up some opportunities for advertisers.
Yeah, look, I mean, local stations have always been home to some local, smaller business advertising. And so the question is, who is that right for? Like, if they're still only a local business, then they don't really need the scale to be able to utilize more stations. So maybe you actually see more national players leaning into that, where they can actually coordinate a buy that hits multiple markets at the same time. But anything, I think, or just smaller advertisers that are national, sort of the D2C companies or digital first companies that have a national audience, but they don't maybe have national TV budgets. You could see them being adept at using new sort of self-service platforms in that way.
Yeah, I agree, especially for some of the large regional chains or car dealership groups. I could see, there could be a lot of benefits for those type of advertisers.
Yeah. How much do either of you know about AppLovin?
Not much.
They are part of my digital endemics composite, Kate. So yeah, I have covered them as an advertiser, not a media owner before.
Yeah, so this is the thing, right? We've always paid attention to them in terms of their ad spending, as you said, as part of our digital endemics group. So companies that were spending heavily in the era of cheap capital in terms of gaining users and revenue. They just earlier this year sold their games division, which is they owned a bunch of games than they would earn on in-app purchases and in-app advertising through that. And I admit we have been remiss in terms of sort of keeping better track of how fast their advertising revenue was growing. And they've expanded beyond games. They actually have Whirl, which is a CTV platform. So then it's been making waves, I think, in our world as to how rapidly they're growing advertising and how big of a player they actually are. So I pulled up our media owners model here. So yeah, AppLovin was, let's see, they announced advertising revenue of $3.2 billion in 2024, which would put them just below the tail end of our top 25 media owners league table. That was up from 1.8 billion in 2023. In the first quarter of this year, revenue was 1.2 billion, growing 71% over the prior quarter, and they just in Q2 did 1.3 billion in advertising, 77% growth over the prior quarter. I mean, at this pace, even if they decelerate growth over the next 2 quarters, even if it's a bit slower, they're gonna rocket from 27th place or something up to 19th or so within the top 20 of our advertising owners, which is a pretty big rise. They've also said, I think 48%, roughly half of the business is international, not just US based. So definitely one we're going to be talking to our contributors about too when we're doing our forecasting for this year, next year. And we look at where all of that revenue is sitting and how we're classifying that. And we'd like to get to having gaming as a separate category as much as possible. But any of that surprising scale, getting to $5+ billion probably this year, 5.2 or more?
It is fascinating, Kate. And I think just how much they're trying to divest from their kind of non-core assets, as they frame it, into pursuing advertising as a business model is super interesting, right? And that growth is just evident in the figures you mentioned.
Yeah.
Yeah, no, I would agree. I mean, considering that most, almost 50% of the revenue is outside the US, it kind of flies under the radar here in the States. You don't hear it talked about as much as it probably should be, especially given the scale of growth.
Yeah, so they have several different services or software. They used to call this business line the software line, and then they had their apps business. Now they're talking about different offerings within that. So Max, they say advertising clients use Max to optimize purchases of advertising inventory. And then they have Adjust, which is measurement analytics. So looking at user journeys and allowing marketers to do measurement attribution and fraud prevention. And then they have Whirl, which is the connected TV platform to distribute streaming revenue, maximize revenue, and acquire and retain viewers or subscribers. So playing across all of these areas and obviously continuing to grow. I mean, we looked at Reddit was 84% growth or something like that, but off a much, much smaller base. So I think, interesting to see that AppLovin at sort of a 2x, almost 3x size is also growing on that kind of a pace. All right. Well, so another large player, I think what's the takeaway there is keep an eye on it. We'll be doing more, looking into that as well as we get into our forecast for December. Again, I think, having more innovative and scaled players for large advertisers to work with is generally good. I think it also points to the different types of content that advertisers may be looking at over the next several years. Maybe it's mini-programs, even outside of China, gaming, given how fast that area is growing for Tencent as well and other players we talked about. So definitely lots to take away from this week's news. And then next week, we may be on a hiatus. We'll see. But when we come back to you, we'll dig into the news of the week again and get into all the media and advertising hot topics. Any final words?
No, I think it's, now that we can catch our breaths from earnings season, get caught up and dig a little bit deeper. And then, of course, we've got, I'm sure, a very, very busy fourth quarter coming up.
Yeah, as we're looking into our December forecast and what our new ranking table might look like, I think there could be some significant shakeups as to the rankings of our top media owners. I think we might see, who do we have? I think Comcast and Disney might trade places at the end of this year. I think JD.com, off the back of some of that subsidies growth, may come up the league table. I think it might be the first time that Meituan passes Warner Brothers Discovery, or Warner Brothers now, as we'll have to separate out that revenue. So that'll be interesting.
We have about a year for that.
Yeah, I think Paramount probably drops down the table a little bit, considering they were talking about a couple tough quarters. We'll see how much something like the UFC deal brings to that. And then you have AppLovin climbing the ranks alongside Walmart, with a couple of other players, potentially Snap losing a couple places, and Xiaomi climbing as well. Really interesting to see how all of that is likely to shake out as we get into the final 2 calendar quarters of the year.
Yeah, and I think just looking at, even in this current landscape, how much of these advertisers are spending, right? You mentioned about AppLovin. Their sales and marketing expenses grew about 42.7%. JD.com, their marketing expenses just over doubled in the same quarter. So just speaking that spending in some of these players has not slowed down as you'd expect.
Excellent. Well, as a reminder, the WPP Media Intelligence podcast is meant for informational and entertainment purposes only and should not be taken as financial advice. And we will chat to you all next time. Thanks, Jeff. Thanks, Nidhi.